Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast with Russell Jacobs. Today, I am going to talk to Russell and really kind of interview him surrounding behavioral finance and behavioral biases, because unless you've been under a rock, which most of you haven't, you've noticed that the market has been taking massive swings up and down. And everybody has a reason behind it, whether it's the elections, whether it's the primaries, whether it's the coronavirus. Really, it doesn't really matter. There's just always explanations for why the market does what it does. And we have done a lot of studying in our industry about this. And so that's what we're going to talk to Russell about today. So the format today is going to be, I am going to give a definition of a term. And then Russell is going to talk to us a little bit about his personal experience with these sorts of biases and what him and his partner, Carl Coolidge, does to help overcome some of these. So Russell, welcome to the show.
Thanks, Matt. Happy to be here.
So let's begin by just talking about the different things that we've been seeing in the news and, the big market fluctuations. There's something called herd mentality here, right? That herd behavior basically means that people mimic what's going on with the financial markets herd. It's really, really notorious when it comes to the stock market and has contributed to major crashes, corrections. How many of these have you seen in your life when it comes to reactionary herd behavior?
Well, I started working in the business in 1985, Matt. So my first experience with that was in 1987, which, really, that was before instant information. So things didn't happen this fast. And so volatility, while there and sometimes pronounced, was not instantaneous per se. At least with what I would call the common person. So that was the first time, and there have been various ups and downs along the way. Volatility has been a normal part of the stock market ever since it's been recorded. So the key to it is just to stick with your plan and understand your time frame and your goal and not give into that. But when you're sitting tight and everybody's fleeing the building, and intuitively you should sit tight, it's still very difficult to overcome. And we see that often. And, there's so much negative focus on any information because that's what sells news and content, that it can be overwhelming at times. But I'd say 1987 was
that was your first.
I remember it very vividly. And the irony there, too, is that, within 90 days, there had been a very nice rebound, and you continue to see that. And you can't have an up without a down, as they say.
Well, sure. Well, and then we had 2001 and 2008 were the other two big ones.
Yeah, you had the tech wreck, where all the tech companies had risen to just incredibly high levels. And of course, anything that goes up is going to come back down to a reasonable level. I think irrational exuberance was a term that was used by some talking head. And it might have even been Alan Greenspan. I forget who coined that phrase, but, just like you have the herd mentality rushing out of the building because they think it's crashing down, people rush the other way too. And if you're jumping in and jumping out, you're going to often jump out too late and jump back in too late. Or you just never do it at the right time.
And so that is one of the biases that we're going to talk about. You just led me right into that. So thank you for that. Is the disposition bias. So the definition of this is when investors sell their winners and hang on to their losers because investors think that they want to realize their gains quickly. So now you guys manage money in a little different way. I think we should probably start there because the amount of disposition bias that can happen within your financial plan is a lot less than I think an individual investor investing in individual equities. So talk about disposition bias, please.
Yeah, I actually see it on the upside often too. But yeah, people want to hold on to the dog in their portfolio. Nothing against dogs, but I love dogs. But when it's going down, you don't want to sell that loser under the false hope in this example that it's going to come back. So you ride it all the way into the ground, and the only benefit of that is then you have a total loss you can deduct from your taxes. But people want to wring that last dollar of gain out of their winner also. So, but they will certainly sell a winner before they'll sell a loser. But it's called buy-sell discipline. And if you're going to be focused on a smaller basket of individual securities, it could be mutual funds too, or any asset class really, but you need to kind of have kind of a top and a bottom. And all analysts who are professionally doing this, they have ranges of these securities, and it's not emotional. So if it hits the mark, unless the fact pattern has changed where they raise the sell time or the buy time, they're going to stick with the plan. So you have to have buy-sell discipline. And why we're different is because we use managed portfolios, and depending on your level of asset, that'll determine whether it's mutual funds or ETFs, which are exchange-traded funds that trade like stocks, or individual portfolios of stocks and bonds. It just depends. But wherever you are, there's going to be active management to the asset allocation, and the buy-sell discipline is going to be there. And that's what really protects people, the diversification and the buy-sell discipline. And often individuals who don't have our moderating counsel and ongoing communication can make these errors in judgment that can be quite severe from a financial standpoint.
Yeah, they can be brutal. Especially if you're already in retirement and you've gotten that last paycheck that you've ever gotten. A lot of these biases can really, really harm your ability to even stay retired, which gives us, the next one is confirmation bias. So this is when investors get information that confirms an already held belief in investment or what's going on in the world, even if that information could potentially be flawed. Now, Russell, I know that you and Carl deal with this a lot because there's so much information out there and not all of it's true. What is something that you do in a communication strategy or with your clients to help reduce this confirmation bias?
Well, we just have to remind people to stay objective in the analysis. And again, this is about staying focused on your long-term goals and objectives and what you're trying to accomplish. And, if you get to the point of not making sound decisions because you're literally just looking for nuggets that are confirming your sentiment, you're going to not do well. And, we really do try and get people focused on not so much the individual mechanism as we do the journey. And that's kind of a lot of what we do is counseling and hand-holding and reminding. Mm-hmm. And it starts with creating a plan so that there is a platform upon which to refer, if that makes sense. Because, when people are operating in a vacuum and they've never taken the time to build a financial plan that kind of creates a blueprint and then projects forward their path to success, it just gives you a lot more confidence to stick with the plan. You've heard the term stick with the plan. That's because there is a plan. Mm-hmm. When people haven't taken the time to invest in themselves to build a plan like that, there's much more tendency to run toward that confirmation bias, because you're going to be much more fearful and you're going to be much more apt to make those type of mistakes that can blow you up. And you're not going to have created the breadth of options that you might if you took the time to build a plan. I call it multiple buckets of money, where perhaps you build 10 buckets of different assets and there's a lot of non-correlation there, meaning they're not all performing the same way. And so from that perspective, you can be much more comfortable in the fact that if you have 3 buckets that are leaking due to whatever the factor may be, you have 7 that aren't. Yeah. So you can't blow yourself up, if that makes sense. A lot of what we are about is creating a known sentiment that you can reach your goals and you can do it in a prudent manner, and therefore you don't have to take so much risk, and you also can stick with your plan when things get choppy or rough like they seem to be right now. Although if people kept in mind how much their portfolios went up last year,
Yeah.
even taking into account the pullback and correction that we've had, they're still in pretty good shape.
Sure.
But people forget that very quickly.
Well, I'm going to harken back to this. It's something you just said there, which is, sticking with the plan. All of these biases don't affect you as strongly if you're measuring the bias against the plan, especially this next one. So this is the experiential bias, which I have always struggled with, Russell, on how you, as a financial services professional, somebody who lives and breathes the markets and planning all day long, how this doesn't affect you. And the definition is that the memory of recent events makes them biased or leads them to believe that the event is far more likely to occur again. So, there are a lot of people who, even though that 08, 09, that's 10 years ago, 11 years ago now, that's still fresh in people's minds. How do you, as an advisor, make it so that this experiential bias doesn't affect you when you start seeing, Chicken Little saying the sky is falling?
Well, because I think what we do is turn that bias into a positive, because when you think about 2008, yes, the S&P was down almost 38%, and it went down through March of 2009. But what happened in March of 2009? A large bounce in the other direction that has continued until recently, and 2019. So 10 years of a banner year, possibly the longest bull market in history, and it may not be over. Growth prospects in the U.S. are still positive, and the Fed just cut rates by 50 basis points. That's just announced, so hot off the press. But people who stayed with their plan and really continue to invest. We have a lot of people who do what we call PIPs, which are personal investment plans. They invest on an ongoing monthly basis. And people who did that have been well rewarded just by staying with the program. And, so experiential bias has a negative connotation. But if you use experience as the old axiom, history repeats itself, well, the market's gone up and down in some cases pretty dramatically throughout the history of the market. But the key has always been to stay in, because you can't time it very effectively, because you got to make two good decisions, when to get out and when to get back in. And it's incredibly difficult to do that. And so sticking with it and taking advantage of these dips, even when they're extreme, is the key. I think sometimes people tend to say, oh, well, this is finally it. Our country and the world are coming to an end. And if you cross that line of doomsday thought, that's hard to recover from. But most people are just seeking reassurance. And we have the data points to do that. In fact, I just looked recently at a graph that showed how long the markets took to recover after previous epidemics or pandemics. And it's not very long.
Right.
It's in weeks or months, not years. And so if you get out, like I had a person tell me this week, I lost $60,000. I'm like, well, how much did you go up last year? It was twice that much. Okay, so, and you didn't sell anything, did you? No. So, yes, on paper, their account went down $60,000, which was about 10%, but it bounced back 5% yesterday. So you can't really make short-term movement unless you really want to wreck your plan. And I circle back to, it's all about the plan. Having a plan, knowing your risk tolerance with certainty, because the more you know about yourself and your long-term financial journey, the less likely you're going to make one of these potentially fatal financial mistakes. And even if not fatal, it can set you back for years. So you have to know yourself and your plan and stick with the plan. And don't freak out.
So let's talk about that, because loss aversion is the next behavioral bias, and you just said something that was interesting. So let's talk about the risk profile, because that's really what loss aversion is about. It's about this overall concern that that losses are going to be, or that what it is they're more concerned about the losses than the gains. Just like you just said, oh my gosh, I'm down X. Well, you didn't really realize that you were up X, this last year. With the plan specifically, and with your guys taking a risk tolerance, you can help with this loss aversion. Let's talk about that.
Yeah, it's basically about getting positioned properly at the outset before the train leaves the station. That's the investment train. So what we do is we first, of course, gather complete facts, but then we actually use a software called Riskalyze to take them through a battery of questions. I liken it to visiting if anyone who's ever visited the optometrist or the ophthalmologist, where they flip the lens and say, is this sharper or this sharper? And it really helps us zero in on that, because you score between 1 and 99, 99 being the most aggressive and 1 being the most conservative, by answering these questions about how much volatility you can stomach and sustain. And then it continues to refine that, and then you get a number. And so say I'm like a 92, so I'm a fairly aggressive investor with my portfolio. But then we also take people's holdings across the board, and we put the holdings through this same analysis, and the portfolio gets a score too. And we often see mismatch between your personal number, your risk profile number, and your portfolio's number. And that creates angst and incorrect response from people as well. So if you're an aggressive investor too conservative, you're going to be unhappy. If you're a conservative investor who's aggressively allocated, you're going to be even more unhappy, because you're going to see the volatility. And there's a thing called standard deviation, which I call bounce factor, how much up or down potential your portfolio has. For those less aggressive investors, we want to compress that range where it doesn't bounce up and down so much, and they're willing to take a lower return. Say someone who maybe is comfortable with 6% is going to have less volatility. Like in 2008, they might have been down 6 to 10% in that portfolio, not 38. Someone like me who may average more like a 10 or 12% return over time, but that portfolio along the way, that compression range is going to be very wide. So you're going to have a lot of ups and downs and peaks and valleys. But because we've taken people through this analysis, really, when you think about it, the down is an opportunity to put more money in. It's actually a great thing that it happens from time to time, because if you went to the grocery store and your favorite item was normally $20 and it's $10, you're going to buy more.
Yeah.
You might buy 2 or 3.
Yeah.
If it's $40, you're going to buy 1 or none. But people have reverse psychology on themselves with the market. So, we like to buy things on sale or cheap. That's why Walmart is so big. That's why Amazon is so big. But we get mentally screwed up in our own minds when we can't apply that same logic to the market. So having a plan and sticking with it allows you to deploy that logic more appropriately, particularly if you know what your risk number is and you know your portfolio is matched up with your risk number.
Let's talk about the last bias here to wrap up today's podcast, which is the familiarity bias. Now, this happens a lot of times when there's a closely held company or somebody who's worked with an organization for a really, really long time, that they hold more of one position within their portfolio than others. And I know you guys deal with this often because of a lot of the wealthier clients that you work with are either business owners who have been executives. What do you do with familiarity bias?
It's one of the more challenging ones because, people, it's hard for them to leave that asset that made them rich, and yet concentration risk is what that's called, is very real. And, I'm aware of a person who, you remember the company WorldCom? This is going back a ways, but there was a communications company, WorldCom, and this guy had a boatload of it. And his net worth went up to $200 million. But it was all in one stock. And he never sold it and it went all the way back down to nothing.
Oh.
So, and there's examples throughout history of people who that's happened to, but whether it's Coca-Cola or IBM or Apple or, people work at all these companies and they can get very rich, in some cases become billionaires through these companies, but take that all the way down to people working at smaller companies where they get interest. And if you have too many of your eggs in one basket, you're at risk of losing everything in a down market. So you have to move away from that. And so what we try and do is create a diversification plan where we're going to trim over time, because we want to try and move down where you really shouldn't have 10% or more of one asset category in one thing. That's not realistic for some people, but it shouldn't be 80 or 90 or even higher, which we see with some of the smaller business owners especially. And so that's like owning what I call a triple micro cap stock, where people are concerned about risk, and yet they have 95% of their net worth in the small business that they own. And they're just not logical. I was talking to a person last week. He felt like the business was his third child. Literally, he was not. That's kind of how he felt like about it. And so he couldn't really sell it or wouldn't sell it, and you get attached to these companies and these stocks. So the point is, you have to be able and willing to diversify yourself away from that one company or one stock that perhaps made you rich, because it can also make you not rich. Does that make sense?
It does. And so here's the kicker, right? Everybody who's listening to this podcast right now needs to understand that they have naturally ingrained biases within them that actually go against the long-term benefit of their financial plan. And as Russell just said, and I know if you sit down with Russell or Carl, they're going to talk to you about sticking with the plan. And sticking with the plan allows you to measure what's going on in the world against something that is real, that is meaningful to you, which is your financial plan. So Russell, man, thank you so much for walking us through these behavioral biases today. This was really good information, and I'm really looking forward to picking your brain again sometime soon.
Thanks, Matt. I enjoyed it. Look forward to speaking with you sometime soon.
All right. Make sure that if you know somebody who's experiencing some of these, if you're at a dinner party and you're like, oh my goodness, I just heard somebody say something about familiarity bias or loss aversion, please share this podcast with them, because you can help your friends and family make better financial decisions and stick to their plan if they have one. And if you know somebody doesn't have a financial plan and know how powerful that is in your life, please make sure that you have them reach out to Jacobs, Coolidge and Company, which is a very, very easy web search. And Russell, what's the website again?
Our website is jacobsandcoolidge.com. Please check us out.
Yeah, check them out. All right, everybody. Russell, thank you very much. And for everybody at Jacobs and Coolidge and Company, this is Matt Haller, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs, Coolidge and Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.